Hello and welcome to SCG's 2021 Public Policy Conference, Build Anew. I'm Laura Seaman, CEO of the League of California Community Foundations. I go by she, her pronouns, and I'm a Caucasian woman with blonde hair, green eyes, and wearing a black top. I'm grateful to SCG for inviting me here today to share a community foundation perspective on philanthropic reform, particularly in light of some recent proposals circulating in California and nationally. In California, these efforts have included a pair of bills in the state assembly last session, neither of which passed. The original bill, AB 1712, aimed at requiring annual fund-by-fund, account-level reporting from all donor-advised fund sponsors in California over a certain asset size threshold. This year, there's a new bill from AB 1353 that will be a 2-year bill, meaning it'll be heard next year in the state assembly in 2022, and doesn't currently have any language indicating what specific regulatory approach the author might take or what implications there might be for DAF sponsors, community foundations, or otherwise. Nationally, there are a number of proposals, none of which have yet been introduced as legislation, but the most prominent of which at the moment is the initiative to accelerate charitable giving. The key points in this proposal include, first, with respect to private foundations, that they not count salaries or travel expenses of family members or distributions to donor-advised funds toward payout. That donors not avoid private foundation status by funding their entities through a donor-advised fund, and that the private foundation excise tax be eliminated for any year that the payout is 7% or higher, or for any newly created private foundation with a lifespan of 25 years or fewer. Second, with respect to donor-advised funds, this initiative proposes that there be two options for newly created DAFs. The first is the so-called 15-year DAF, where tax incentives remain unchanged if funds are distributed or if advisory privileges are relinquished 15 years or fewer from the original donation to the DAF. Or alternatively to the 15-year DAF, the so-called aligned benefit rule for donors who want more than a 15-year lifespan of the DAF to not receive the income tax deduction until those donated funds are then distributed to an end charitable recipient. The language offered by proponents of these national level proposals reflects some of the same narratives and hypotheses that we've seen in California about how DAFs work, how donors, sponsors, and nonprofits use them. These hypotheses tend to center around a few ideas, including that DAFs are not actively granting dollars to nonprofits, that payout rates may not be as high as other giving tools because there's not a mandated floor, that the tax benefit to donors may not align with the public benefit in terms of grants going out to charities, that giving from DAFs should be higher in a crisis like the COVID pandemic that we've been navigating now for over a year, and that DAFs present a new barrier to nonprofits that makes it harder for them to build donor relationships and cultivate long-term support. Let me be the first to say I don't presume to be an expert on all aspects of donor-advised funds, nor on tax policy, or to be able to dig into all of these claims in depth in 15 minutes. But as a devoted evangelist for the model of community philanthropy, today I want to build on this framework of proposed reforms, particularly around payout rates and time horizons, to share a perspective on how DAFs fit into the ecosystem of long-term local giving at many community foundations across California. As many of you know, donor-advised funds are a giving tool originally born out of community foundations back in the 1930s, as a way for groups of neighbors to pool their resources, come together to support local causes and organizations that were building a better future for their community. During the Great Depression, donor-advised funds at community foundations in California supported food and housing for families fleeing the Dust Bowl. In the 70s and 80s, they kept arts programs alive and food banks open across the state. In recent years, they've helped communities recover from fires, floods, earthquakes, and other disasters. But the world changes, and it's important to understand how donor-advised funds are serving our communities today as a tool for charitable giving. So let's revisit a few of these central hypotheses that are driving these recent calls for reform. First, the idea that DAFs are not actively granting dollars to nonprofits. In order to receive national accreditation, community foundations must have an active funds policy outlining the maximum amount of time that a fund can go without making grants. By far, the most common timeframe is 36 months, after which the most common action that's triggered is that those funds get rolled over into a discretionary grant-making pool. We see active funds policies not just as a best practice for community foundations, but as a potential path forward for a common sense reform that could standardize and bring more transparency to how the field treats inactive funds. Second, on the idea that payout rates may not be as high as other giving tools because there's no mandated floor. Of course, we know that payout rates from non-endowed DAFs across all types of sponsoring organizations outperform most private foundations. And among league members, the median payout rate for non-endowed DAFs in 2020 was 23%, up from 20% the prior year. And some community foundations saw payout rates last year in excess of 60%. We also know that many DAFs at community foundations are endowed, a fact that is worryingly absent from any of the proposals circulating at the federal or the state level. Among league members that have endowed DAFs, and the majority do, that percentage ranges from 3% to 92%, with a median of 34% of funds endowed. Just like any other endowment, these DAFs are governed by the Uniform Prudent Management of Institutional Funds Act, UPMIFA, and their annual payouts are capped. The League believes that any common sense DAF reform must acknowledge and preserve the important role that endowed DAFs play in community philanthropy. Now on to the idea that the tax benefits to donors are greater than the public benefit DAFs provide in the way of grants to charities. In California, a number we've seen quite a bit in the policy conversation is that the state forgoes about $340 million in tax revenue per year by allowing incentives for contributions to donor advised funds. What we see from the community foundation perspective is that in 2018, just over $1.5 billion in grants flowed from DAFs at community foundations to charities, most of them local. In 2019, that number was just under 1.9 billion, and in 2020, it skyrocketed to over 2.8 billion. And that's from league members alone. We have 30 community foundation members across the state. This is not counting other community foundations in California. It's not counting any other type of DAF sponsor like single issue charities or the commercial funds. And again, this is not in assets. This is in dollars flowing to nonprofits from donor advised funds, and largely as unrestricted, locally controlled, locally deployed resources at a rate that we see as being a really exceptional return on public investment for our local communities. Then there's the idea that giving from DAF should be higher in a crisis like the COVID pandemic. I'm confident that I speak for all community foundations when I say I couldn't agree more. Research out of UNC several years ago confirmed that DAFs play an important counter-cyclical role in crises, smoothing out the flow of resources to nonprofits when markets are volatile and traditional giving contracts. And of course, that's because the funds are already earmarked for charity irrevocably and ready to deploy when disaster strikes. And this is exactly the performance we see from comparing 2019 giving data to 2020 giving data across just our member foundations, where overall giving from DAFs jumped 44% year over year in response to the COVID crisis and the state's devastating fire season. And finally, I want to revisit the idea that DAFs present a new barrier that makes it harder for nonprofits to access resources than other ways of giving. Partly this is based on a belief that most or many DAF grants are anonymous, and that this prevents nonprofits from building donor relationships over the long term. Actually, new research from Stanford just last year shows that the vast majority of DAF grants are not anonymous. And even among the largest commercial DAF sponsors like Fidelity and Schwab, only 3 to 5% of grants are anonymous. The rest arrive along with a letter from the DAF sponsor identifying the donor so the nonprofit can reach out and start to build that relationship. Another way that community foundations see DAFs as actually breaking down some barriers in nonprofit fundraising is that DAFs allow donors to give non-cash assets like property or stock to small charities that otherwise couldn't accept or process them directly. And finally, on this point, DAFs give community foundations an opening to help people become better givers and lifelong givers. Many DAFs created in the last few years, for example, were set up on the advice of a tax professional or a wealth advisor, or when a donor experienced a life event like the sale of a property or a business. Community foundations see these openings as golden opportunities to engage in donor education and to introduce these new donor advisors to all the other ways that they can support their community for the long haul through scholarships, field of interest funds, giving circles, bequests. I'm sure there's a more graceful way to say this, but the gist is that donor advised funds can be a really powerful gateway drug to a lifetime of philanthropic giving. But I don't want to make light of this concern. Whatever your stance on how well donor advised funds work, we all ought to be concerned that many nonprofits don't seem to feel that they understand how to access these resources. We should all share a goal and a sense of responsibility as funders for tearing down obstacles to resources that high quality, high impact nonprofits need to be successful. It's up to the funder community to help nonprofits navigate and bridge those gaps when the tools that donors use to give are shifting. We ought to be doing everything we can to demystify DAFs for nonprofits. We ought to be doing all we can to introduce more nonprofits in our communities to donor advisors. As community foundations, we ought to continually renew our commitments to the National Standards Accreditation process. And we ought to take new concerns seriously as they emerge. For example, the way that the East Bay Community Foundation has led the field in preventing hate group funding is an inspiring example. I also see this concern about barriers, though, as being based on an idea of DAFs as a type of funding rather than a tool for giving. If you run a small nonprofit, instead of asking a question like, how can we access DAFs? If you're a savvy fundraiser, which I'm not, you're probably asking, how can we help our donors use their DAFs to support our nonprofit? Community foundations offer DAFs as one of many giving tools, one of many payment methods, if you will. These donors use DAFs at community foundations as just one of many such tools to support their community, the same way members of a credit union use many tools to support themselves and their families. They may have a debit card, a credit card, an IRA, carry cash in their wallet. Similarly, donors may have a DAF at a community foundation, use their PayPal account to support a friend's Facebook fundraiser, send a check to the food bank every month, and then put $20 in the collection plate at church on Sunday. We all, funders, nonprofits, and donors alike, should see donor advised funds as a tool for giving rather than a type of giving, and do all we can to lower the barriers to using these powerful tools effectively. Our shared goal for any giving tool should be to get sustained, flexible, locally controlled resources into the hands of high impact nonprofits to support their long-term missions of serving the needs of a community. I'll close with one last community foundation perspective, and that's on the power of perpetuity and the role of long-term giving horizons. When we teach people how to build wealth and security for themselves and their families, we tell them about the importance of saving for the future. We draw charts showing the power of compound interest, and we talk about the importance of investment growth over the long term to meet their family's future needs. Community foundations occupy a unique and special corner of philanthropy. They exist, as we say, for good forever, and their job is to build community wealth and to steward those resources in perpetuity to meet the needs of a place and of its people, not for years or even for decades, but for generations. Back in the 1980s, one of the League's member community foundations was approached by a donor who had had a financial windfall. And she wanted that money to support local nonprofits. So she set up an endowed donor advised fund with this community foundation with $9 million. Today, that fund has granted more than $9 million to local nonprofits and still has $9 million in the endowed fund that will continue to grow and grant and support that community when the original donor's great-great-grandchildren now live there. For places that aren't major tech hubs or don't have ballooning populations of wealthy donors, these endowed DAFs are often one of the only sources of sustained, locally controlled philanthropic capital for that community. Again, our goal for any giving tool should be to get sustained, flexible, locally controlled resources into the hands of high impact nonprofits to support that long-term mission of serving the needs of a community. This is the core vision of every community foundation and something that I hope we can all rally behind as we think about using public policy to shape the future of generosity in California. I want to thank SCG for this invitation to share the Community Foundation perspective, and I want to thank you for spending this time sharing this reflection with me. To find more about the League's work, I invite you to visit us at lccf.org. Thank you.